In a big surprise, the Bank of Canada decided not to increase interest rates this time. But they will announce their next decision on March 2nd, and they may increase interest rates then. How can you prepare? Ted and I discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back to the studio. The last time you were on the show a couple weeks ago, we were in the middle of a snowstorm, so we recorded over Zoom. And today is another cold and snowy day here in January, but we toughed it out, made it into the studio. We're going to talk about interest rate increases. So the big news this week was the Bank of Canada interest rate decision. So first question, Ted, have you ever borrowed from the Bank of Canada?
I have never borrowed from the Bank of Canada.
Have you ever borrowed money from a chartered bank for a mortgage, car loan, credit card, anything?
I definitely have.
Aha. So you care about what the bank down the street charges you, but not what the Bank of Canada charges you. Is that correct?
Well, yeah, it's not as simple as that, right? One influences the other.
Okay, so let's talk about this.
Okay.
That was an excellent intro, I thought, that we read off our cue cards there. So I'm going to quote from the Bank of Canada's website, and I know you go to this website.
This should be exciting stuff, folks.
Day.
Hold on to your seats.
There is nothing better than this. I'll put a link in the show notes if you want to see what I'm talking about. But so every business day, money is moving back and forth between the banks. That makes sense.
Right. Because
you buy something with your debit card,
right,
and so the money has to go from your bank account to the merchant.
Yeah, I bank at TD. The store actually uses RBC, and the clearinghouse uses Scotia, and so the money moves around and around and around and around.
Makes sense. But it never balances out exactly. So at the end of the day, all the banks have to settle up. So a bank can borrow from the Bank of Canada to even things out.
Okay.
And they borrow at the overnight rate, which is set by the Bank of Canada.
And that's the one that's published all the time that people are
exactly.
quoting.
This is the one we're talking about. And so the Bank of Canada has this band. They call it their operating band. And so if the deposit rate is 2% and the lending rate is 2.5%, then, you know, the target rate is somewhere in the middle. Okay. So the Bank of Canada maybe will pay me 2% if I'm making these numbers up because clearly these numbers are wrong.
Right.
But I'm using the numbers right from the Bank of Canada's example website. So they might pay me 2% to deposit with them. They might charge me 2.5% to borrow with them.
Right.
So how many banks are actually borrowing from the Bank of Canada every night?
Yeah, probably none.
Probably none. It's not really a thing. Right. And why not? Well, because they can just borrow from themselves.
Right.
Like they're banks. That's what they do, right? So the Bank of Canada rate really doesn't mean a whole lot other than it kind of sets the floor, if you want to call it that.
Yeah, it's the anchor that everything else is tied to.
There you go. And therefore it influences everything else. So first question to see if I got two questions to see if I can get you into trouble today.
We're going to talk about payday loans?
I will mention payday loans at some point just to sneak it in there. But my first question is, so you go to the bank, you borrow money from the bank. Why doesn't the bank just set interest rates that they're willing to lend you? Why do we need a government institution to set interest rates? It's not like the Bank of Canada or the government is setting what the price of bread is or what my Netflix subscription is or anything like that. Why do we need a government to do that?
Okay. So you want the great big picture?
Sure. Give me the big picture.
Great big picture. So you could just let it float for free and let the market determine what the interest rates are going to be. And there's a lot of us, probably myself to some extent included in that think that's the right way to be. You let the market do what the market is best at, and you'll get to the right answer. It may not be the answer that you want, but it'll be the one where there's equilibrium in the market, which means the forces are balanced properly. What governments do is they screw around with different policies. The best one is income tax, or the worst one is income tax. They try to influence how you're going to act by setting different policies, and that has an impact on the market. Well, once you start using one vehicle to influence the market, you end up having to introduce 2 or 3 other tools to try to counter the effects of the first one. So they put this guaranteed interest rate model in place so that they've got some sort of target for people to shoot at. They've got a baseline to say, this is what we think it should be. I mean, the banks can charge whatever the hell they can get away with. But because the government has said, this is the bank rate, they can't charge too much more than that because everybody knows, well, hell, this is what the government says you should be charging.
Yeah, and you're
that's so simple.
Yeah, and what you're talking about is the line between I'm a total free market and I'm a total the government control. Well, nobody is one or the other.
Right.
We're all somewhere in the middle, and so it's just where do you draw the line? So, you know, you mentioned taxation. So we have taxes on cigarettes.
Right.
And they're really high. Why? Well, because the government wants to discourage people from smoking cigarettes. So is that a good idea or not? Well, I guess we can all debate it, but that's an example of a policy used to influence behavior.
That's right.
And interest rates, same thing. They are used to influence behavior. Now, when you read the Bank of Canada website, they have a section called their mandate.
Yes, this will be fun.
And it's not vaccine mandates, it's actually interest rate mandates. And so the bank has 4 core functions. The first one is monetary policy. The bank's monetary policy framework aims to keep inflation low, stable, and predictable. So they've done a fantastic job. We'll look at inflation numbers in a
Do we know when these mandates were written?
Yeah, decades ago.
The 70s, right?
Yeah,
when there was an inflation problem?
Exactly. And they've also got, they also have the, safe financial system and currency and funds management, whatever. So how is it that interest rates would impact inflation?
Well, so I've got $1 to spend on whatever it is I want to buy. And out of that $1, I got to buy the thing and I got to pay the interest. And so if more of my $1 goes to paying the interest, less is available for me to buy the thing. And the converse of that is also true then. So if the interest is a really small portion of the $1, then the price for the thing can be higher to eat up more of my $1. Does that make any sense?
That does make sense. And we'll go through some examples because real estate would be the obvious one.
Oh, God, yeah.
So as of right now, the inflation rate, well, let's see here. In 2021, it was the highest rate since 1991. It was about 3.5% for the year.
Right.
In December, it went all the way up to
4.8,
almost 5%, which is the highest it's been since September of 1991.
And what was it then? You told me that 8% or something.
Yeah, it was high. So is it as simple as saying that if we raise interest rates, we reduce inflation? Like, is it that simple?
I mean, I don't think that's the easy solution, but it's one that everybody understands. Like, if you make it more expensive to borrow money, you've got less money available to actually buy the things that you want to buy.
Which is why they're doing it. So I'll put some graphs on the screen here for people who are watching on YouTube. And if you aren't, well, you should be, because you want to see our pretty faces for this audio podcast.
Got a great face for radio.
Oh, we're beautiful people. So YouTube, like, subscribe, the whole commercial. Insert it in your own mind here. So first chart I'm going to put up is the Bank of Canada target interest rate going all the way back to 1960. That was before I was born. I believe it was before you were born, too.
Yeah, December of 61.
There you go.
So when I was on the scene, 5%.
Yeah, it was a really low number. So the peak interest rate, peak Bank of Canada target interest rate was July 1st, 1981, 40 years ago almost, 20.78%.
And I remember financing a car in 1981 because I graduated school and was starting to doing stuff.
And roughly what was the interest rate on that?
I believe it was 23.5% or something ridiculous.
It was a huge number. So now you said that inflation is at its highest it's been since September 1991, and the Bank of Canada interest rate in September 1991 was
8%.
8%. So, which tells us, what does that tell us then?
Well, but you just said in December we almost got to 5%. And so that tells me that, boy, it's going to get expensive to borrow soon.
Yeah, you would kind of think. Now, if we look at the more recent chart, because, okay, I don't know if 60 years of history is really what we need to be looking at. So as recently as the period between June of 2015 and May of 2017, which wasn't that long ago, it was the before the pandemic, but the target rate was 0.5%. So pretty low. Yep. And then starting in June of 2017, they started ratcheting up the interest rate, went to 0.75%, all the way up to September 2018, where it got to 1.75%.
Right.
That's a pretty big increase, going from 0.5 to 1.75, 1.7. And it stayed there for 17 months until February of 2020.
What happened then?
Let's go back in history. I don't know if you're students of history, kids, but in March of 2020, a bunch of stuff happened.
The world closed,
and there was a massive collapse in the target interest rate all the way down to 0.25%.
Right.
So, next question. What is the real interest rate?
The real interest rate. Well, that's the interest rate less the rate of inflation.
So, if the Bank of Canada rate is 20%, but inflation is 18%.
Interest rate is 2.
The real interest rate is 2%.
But now what are we at, right?
So you just said the inflation is around 5%, and the interest rate is half of 1%.
So that means the interest rate is negative 4.5%, which means your money is shrinking, which is why you can't get anybody to pay you money on a T-bill or in your savings account or anywhere else.
So now that sounds really bad, what you just said there. It's really bad if you're a saver.
Hugely bad if you're a saver.
Because I'm putting my money in the bank and I'm losing maybe 4.5% a year on it.
Yeah, not so bad if you own stocks, because those are getting artificially inflated because of the way things
because of the leverage. Now let's talk about the thing that is on everyone's mind, and that's real estate.
Right.
So low interest rates sounds great.
Yep.
Is that not the case? So I went to the Butler Mortgage website, and this is not a paid ad for Butler Mortgage, but Ron's been on the show. He's a good guy, so I figured he's got a website. Let's use it. So and I'll put a link in the show notes. You can click for it for yourself. So before the Bank of Canada announcement,
right,
a 1-year fixed rate mortgage was around 2%. And I'm just picking that one term. If you look at shorter, longer, they're all over the place.
We're just making an example, folks.
Isn't that fantastic? 2%?
It's free money.
It's free money, right. So if I've got, and this is the point you were making earlier. So let's say I've got a $100,000 down payment and I can afford a mortgage payment of around $3,900 a month, then the house that I can afford, well, if the interest rate is 2%, it's, let's say $1 million.
Mm-hmm.
If it's a 3% interest rate, then it's less. It's roughly $900,000. And I'm assuming, $900,000 mortgage, 25-year AM, all those kinds of things. But the point is, as the interest rate goes up, more of my payment is going towards interest. And if I've only got a certain amount to afford each month, then what I can spend goes down.
You're back to my dollar. If more of the dollar goes to interest, less of the dollar can go to actually buying what it is you want to buy.
That's the problem with higher interest rates.
Right.
So it's great if you own something.
Yep.
Because that thing, as interest rates are going down, is going up.
Unless that thing is money.
Unless that thing is money, then you're losing. So now, the experts, who you and I are not big fans of, whoever these experts are, they're almost always wrong.
It's not us.
I believe that, what's the old joke? They've predicted 12 of the last 3 recessions, something like that. So they are predicting that interest rates are going to go up a lot this year. I think the consensus could be 6 times, quarter point, half a point each time.
Yep.
Because of high inflation. Obviously, I don't agree with that thesis. But anyways. Let's assume I'm wrong. The experts are correct. Inflation keeps going up. So the Bank of Canada continues to raise interest rates. So what happens? Like in the short term, what happens?
Interest rates go up. The cost to borrow money goes up. I'm not understanding your question.
So is it a big deal though?
Oh, I think it's a huge deal. I mean, this is where you can bring in the payday loan thing.
Right? Okay.
When you borrow a payday loan, they tell you it's It's $15 on 100 every 2 weeks. So you think, it's 15% interest, but it's not. So the same thing applies to when your mortgage goes up. So I've got a 2% mortgage, and I don't know, because of increases over the next year, it goes to 3%. Well, it only went up 1%, but it didn't go up 1%, did it?
No, it went up. What's that? 50%?
50%.
50%.
Yes.
Because going from 2 to 3 is an increase of 1.
1 is half of 2.
Yeah, 1 over 2 is 50%.
So it's huge.
Yeah. So your monthly payment, if interest rates go up 1/4 of a point,
right,
and it's a 25-year, well, in fact, I got some math right here. So $1 million mortgage, 25-year amortization, monthly payments, 1 year closed. So if yours isn't exactly the same, your results will vary. But at a 2% interest rate, your monthly payment is around $4,200 a month.
Right.
At 2.25%, it's up to $4,356. So the difference is $121 a month. Now, does that break you the first time it happens?
No, probably not. Most people have room in their budget. They can make some kind of adjustment.
But in your example, where it goes from 2% to 3%, the interest is now $4,700 a month. So that's an increase of almost $500 a month.
Right. That's a big deal. Because, not only because your mortgage has gone up, but you know what happens at the same time as this is going on? Fuel prices have gone up. Food prices have gone up. The cost of borrowing is always an indicator of what else is going on in the market. So everything is more expensive. And I don't know anybody that can make a $500 adjustment that quickly.
Well, and that's $6,000 a year.
Right. No, it's a big, but the hell with it, month to month. Most people are running on a cash economy. This is how much I got on my pay. This is where it goes every month. And suddenly $500 has to go someplace else.
And that's $500 of after-tax money.
Right.
So if you've got a job making X, well, you got to be making $700, $800, $900 more a month.
Right.
How many people are getting that kind of a big raise?
Right. Well, nobody can do it. Your expenses can change overnight. Your income, it takes months and months because it's just a timing issue for most people.
So we're talking about mortgages, but you said this filters down to everything else. So
right.
if I have a variable rate line of credit, I am similarly screwed.
That's right. So the advantages of variable rates when interest rates are low is that you aren't locked in, so more of your money is going towards the principal. But as the interest rates climb on a variable rate, those payments go up. And so suddenly you are required to make more of a payment every month. And obviously you're dealing with less of the principal.
And we've talked about this on the show before. People are much more likely over the last few years to be getting a variable rate mortgage than a fixed rate because the rates have been way less.
Right.
So you save a lot of money. And, similarly with a line of credit, a little bit of an interest rate increase, boom. If you've got a 5-year fixed loan, a car loan, whatever, well, the interest rate going up doesn't have any effect because it's locked in.
The price is the price is the price is the price.
But variable, you're kind of pooch. Now, what about credit cards? So the typical standard base credit card, I guess, is still 19.9%.
Right.
So interest rates changes aren't going to have a huge impact on that.
Yeah, there'd have to be a dramatic change in interest rates. And so going from 2 to 3 wouldn't be enough to have a big impact on credit card rates.
Unless you have one of those super low interest rate cards, then I guess it would.
Right.
And then, of course, you already mentioned your favorite topic, payday loans. So the law says in Ontario they can charge $15 on 100, which is whatever we've calculated that before, 290% for the year or whatever.
360.
360 if you're paying every year. I'm not good at math. That's not my thing.
Maybe it's 390.
So maybe people, you can do the math.
It's getting higher and higher every time you ask me.
That's right. 10 million%. Well, it's 15 times 26, whatever that number is.
Right.
If you're paying biweekly on 15 on 100. So if interest rates go up, well, payday loans are already capped. It's not going to have any impact on them.
Right.
So there's the good news for you.
There you go. That's the good news.
It's not going to matter. It's all good. So they're already borderline illegal. So I guess it doesn't really matter.
Yep.
Okay. Now let's get to the point here. Do you agree that Canadians are still carrying record levels of debt?
They are.
So any increase in the interest rate, if you're carrying a lot of debt, is a killer.
That's right.
It's pretty much as simple as that.
Yep.
And rate hikes often lead to recessions.
Depending if they do it for too long and they do it too hard, that's true.
So you got the double whammy then. My costs are going up, but if there's a recession, maybe my hours at work get cut. Maybe my paycheck isn't going up as much. So I'm doubly screwed.
Everybody listening or watching knows that the expense side of your budget is the one that changes more quickly than the pay side. And so anything that changes what it costs you to live is going to have a dramatic impact on you month to month because you just can't change your income overnight.
And that's why we're talking about this today. So on our New Year's Day podcast, you remember it well, January 1st, 2022, less than a month ago, episode number 383. I'll put a link in the show notes because I'm sure you'll all want to go back and listen to that again. So I predicted that by the end of the year, inflation will be running closer to 2% as compared to the 5% it is now. Pretty much everyone disagrees with me, so we'll see.
I don't remember what I said. Did I even comment on inflation?
Well, I think you said it would be not quite as high as everyone else thinks, but you're still in the camp that it's going to be higher.
Right.
So if inflation drops, and if we do go back into a recession, and that's a couple of big ifs that I just threw out there.
Yep.
And then it's perhaps likely then that the Bank of Canada won't raise rates 6 times like everyone's predicting. So
it won't be as aggressive, or they might retreat a little bit from what they're doing.
And is that your pull it out of the air best guess? I mean, we have no clue. We're two guys on a podcast. You shouldn't be listening to what our economic
I think the inflationary pressure is coming more from the supply chain issues we have right now than from the interest rates. Interest rates are still low enough that they're not having a dramatic impact. But at 2%, I can say that. If the interest rates by the end of the year at 4%, we got a hell of a problem.
It's a totally different thing.
Yep.
Well, and then there's also this issue about during the pandemic, governments around the world spent a lot of money to support the population.
A lot of money.
And okay, we understand. If you're going to tell people they can't leave their house, you got to kind of give them money to buy food. Don't have a whole lot of choice in there.
Yep.
They are predicting, the federal government is predicting a $160 billion deficit for the fiscal year ending March 31st, 2022. So a couple months from now.
Okay.
And they've got about another $50 billion roughly of unfunded election promises. We're going to do this. We're going to do that.
Right.
So is it true then that they really can't let interest rates go too high, or else they're going to be paying way more on debt? I mean, they got a couple of conflicting things here, right?
Well, they do. And I mean, one of the biggest factors on interest rates is how much is the government borrowing to pay its own bills. And so if they're going to the marketplace to ask for money, it drives up the cost of borrowing too.
It's pretty simple.
Yep.
So, okay, let's go to the practical advice section, because that's really, we've
what we do for a living.
That's what we do here. We've set the stage. So let's assume that interest rates do increase in 2022.
Right.
1 time, 5 times, whatever it is. And I mean, the problem is the same. It's just an issue of magnitude.
Right. So
what then is your advice to the people listening today in this current environment?
So it's almost always our advice. Do whatever you can to reduce your debt as much as possible. Right now, with interest rates being so low, the more money you throw at your debts every month reduces the principal, as opposed to just paying the cost of borrowing.
And that sounds like common sense, but it has been the wrong answer for the last 10 years, because the best answer has been borrow as much as you can, buy a house, the real estate will go up by more, or you gave the example of the stock market,
right.
Leverage yourself up
and watch what happens.
And watch what happens. Now, of course, the stock market is really, if you look at it, there's a few stocks that have gone up a lot,
right,
and there's a whole bunch that haven't. But again, this isn't an investment show.
Legalized gambling.
Right. So we're all for it. We love it. So, okay, you should chip away at your debt. So tell me practically then how you would do that. Would you be making a list? Like what would you be doing?
Yeah. So put together a list and make sure you put on that list the balance that you owe, the interest rate, the expected minimum payment. And then you got to decide, are you the kind of person that needs some quick relief? So you want to pay off the smallest balances first so you can say, yeah, I want to cut that off. Or do you want to take the financial perspective, was pay off the highest interest rate ones first to save yourself the most money? I tend to lean towards the pay off the high interest rates, but either system works.
Yeah, so do I. But I understand if you got $100 owing on a cell phone bill from 3 months ago, clear it off and then you're done.
Yep.
Now, do you factor into your analysis secured versus unsecured? So I have a car loan and I have a credit card, or let's say a line of credit, and the interest rates are roughly the same on both. How would I decide which one, if assuming they're both open, I chip away at first?
Yeah. So I would tend to chip away at unsecured debts first, because they're the ones that are going to be the most expensive, but that may not be the advice you want to give.
Well, it depends on the situation. So if you had a case, and maybe I'm coming up with a silly example, but a car loan and a line of credit that both had exactly the same interest rates.
And that's possible.
So which one would you pick then? Would you still go unsecured? Would you go secured? What would you do?
Well, so if you pay down the car loan, what you're doing is you're improving the security for the lender. So if something goes wrong and the lender comes and takes your car, they've got more residual value in the car. So it's more likely they're going to get their money back. It'll make them happier. Whereas if you pay down the unsecured debt, the only recourse they have against you is to sue you, try and garnish your wages. So,
but if I pay my car loan off completely, so now they can't take my car. Well, I don't have a car loan, so they're not going to repossess my car for not paying it.
Depends on the value of the car. Right? If they end up suing you, if it's below the exemption threshold, then it doesn't matter. If it's over,
so it's
a little more complicated.
So the answer is somewhat nuanced then.
Right, always.
And so you got to kind of figure out, and what about, same question, variable versus fixed? So I've got a line of credit that has a variable interest rate on it, and maybe I have just a standard loan that has a fixed term, but I can prepay it.
Right.
Which would I pick then?
So as long as the standard loan's interest rate is higher than the variable rate loan, I would pay down the standard loan as fast as possible. And at some point, the teeter-totter is going to switch. The variable becomes more expensive than the standard, and you want to pay off the variable more quickly.
Yeah, so it's not as simple as, well, just pay off your debts.
Right.
I think you got to start with exactly what you said. Here's the list. Here's who I owe the money to, how much I owe, what the interest rate is, what the payment is, whether it's variable or fixed, whether it's secured or unsecured.
And figure out your priorities.
And I guess it's also a bit about your risk tolerance too.
Yeah, that's true. I mean, if you're the kind of person that thinks that variable interest rates, the interest rates are going to stay low, so the variable is going to stay cheap, okay, that's good to know too. Maybe I can make more money by, buying Bitcoin. That's one of your favorite topics.
Oh, yes, I think. And anybody who bought Bitcoin in the last month or 2 or 3 or 4 or 6 has, gotten creamed. So
it's a little too late.
Yeah, if you bought it and sold it, then you kind of got wiped out. Sorry. That's kind of what happened. Now, what's going to happen by the time this podcast airs 3 days from now?
Who knows?
Who knows? Could be totally different. Are you a believer or not in shortening the amortization period? So let's say we're talking about a mortgage.
Right.
Is that a good idea, bad idea, or is it entirely cash flow dependent?
Yeah, I'm biased towards the cash flow dependent. But if you're gonna pay down a long-term asset, paying off a mortgage, well, again, in the last 10 years, paying off a mortgage doesn't make a whole hell of a lot of sense because the property values have been going up a lot faster than the cost of the borrowing.
But if things change,
that's right.
And I guess that's kind of the point we're trying to emphasize here. The last 10 years, 20 years, really, we've been in a low interest rate environment. Yeah, okay, there have been bounces. It's not a straight line. But you can't just say, oh, well, it's always been the correct strategy.
Real estate's always going to go up. Interest is always going to be low. And we know that that's just not the case.
Right. But because we've got this recency bias, that's what's been happening. We just assume it will continue to happen. So you got to realize that, and the reason we're doing this show is, we may be at that inflection point now where things are changing and therefore our strategies have to change.
I don't think anybody takes an interest into account as much as they should. We don't teach it in the schools. My kids are all in the public school now and nobody's talking to them about interest. If you don't understand how interest works both for and against you, you're really at a deficit.
Yeah, compounding works both ways.
That's right. Take interest in interest, folks.
Oh, that was the corniest line we've had on this show.
I took that. That's a quote from your book.
Oh, is it? Okay. Well, then it was brilliant. It was no, it's not.
It's not your book.
Are you talking about Straight Talk on Your Money? Still available on Amazon. So, are you a believer in? We're coming into tax season. Some people are going to owe money, but some people will get a refund. Is a refund something you should be using to prioritize savings, pay down debt, bit of both? What's your typical advice on that? Yeah.
So the majority of the people that we talk to use a tax refund as a form of involuntary savings. So they know every year they're going to refund. So that's what they use for their large purchases in the spring. They're going to catch up on things. And so I get that. I don't like the idea that they're lending money to the government, but if it's some kind of savings, it's a good sign. So if you've got the refund, my advice is pay down debt.
Yep. You can't go wrong because it's after tax money and you don't have to pay tax on the interest you save on your debt.
Right.
So it kind of makes sense. Okay. Final question. This is where we do the commercial, blatant commercial. So somebody is watching this today and they're going, yeah, that's great advice. I'll just pay down my debt. Well, guess what? I've been whacked by this COVID thing. I haven't been able to get my full-time hours for the last 2 years. I work at a restaurant, a gym, whatever. Yeah, okay, the economy's kind of sort of opening up a little bit, but it ain't happening for me. My income is still severely impacted. There's no way I can just start throwing a few bucks on my debt. Right. I'm in way over my head. Now, yes, I do believe over the next few months things are going to get better. I'm going to get more hours at work, but that just makes it worse because now all these guys are going to be suing me and trying to garnish my wages.
As the economy opens up, there are going to be people looking to you for their money. They've been pretty relaxed. I get that may not be the right word, but lackadaisical on trying to collect on their debts the last couple of years because you can't get blood from a stone. As things start to improve, they're going to assume that they can get blood from you, and they're going to try to. Whether it's going to be a small claims court action or the actual regular court, or they're simply going to start, the government's the worst one. They'll just start sending demand notices.
And so the solution then is what?
Right. Well, so financial problems don't go away by themselves. You got to deal with them. And the most common solution when you can't deal with the amount of debt that you have, nobody will lend you the money, the banks aren't going to help, you should be looking at something called a consumer proposal.
Which is obviously what we do here at Hoyes Michalos. So you can go to Hoyes.com, punch in consumer proposal, and it's essentially a deal. Okay, that's right. I got this much debt. I can't pay it all. Let's pay a chunk of it. And the creditors at the moment are pretty amenable to that because they realize, well, if we don't take this deal, then
it could get worse. Right now, 3 out of 4 of the people that are filing with us are filing proposals. The fourth person's doing a bankruptcy because sometimes that does make more sense. But if you think you have the ability to pay back part of your debt, you can't deal with all of it, and it's just crushing you. Makes sense to look into a proposal.
Yep, and you're getting rid of all the future interest too, and it's a win for the lender because they'd rather get something than less.
That's right.
It's as simple as that. So there you go. You can check that out. Consumer proposals. Ted, thank you very much for being here. We live in interesting times. I think that's the understatement. So
some Chinese proverb.
There you go. I've given you my predictions about what'll happen. I don't know for sure, but if interest rates are going up, then lower debt is better.
Interest rates are going up.
And they are. So it's pretty much as simple as that. So thank you to all for listening and watching. If you're watching on YouTube, please like, subscribe, hit the notification button. If you're watching this or listening to this on your podcasting app, then again, same thing, subscribe. New issue, new podcast released every Saturday morning. That is our show for today. Until next week, I'm Doug Hoyes. That was Debt Free in 30.